Every U.S. immigration story begins with one of three ingredients: love, talent, or money. And today, we're talking about money. Because when executives relocate internationally, banking becomes much more than simply opening an account. Moving to the United States is not just an immigration process, it's also a financial transition. And one of the biggest mistakes successful professionals make is assuming they can figure out the banking and financial structure after they arrive. Without proper financial planning, even successful international relocation can trigger banking friction, compliance scrutiny, transfer delays, and unexpected tax exposure. Today, I'm going to explain the most important banking and financial considerations international executives should understand before moving capital into the United States. My name is Tapias, immigration attorney and CEO at Loigica. Our firm works with executives, investors, entrepreneurs, and international families navigating U.S. immigration, corporate structuring, and cross-border asset planning. And one thing we see consistently is this: people spending enormous time preparing the visa strategy, but almost no time preparing the financial structure behind the move. And in today's regulatory environment, that creates risk. The transition most executives underestimate. When people relocate internationally, they usually focus only on immigration approval. But relocation changes much more than legal status. It changes how banks evaluate you, how money moves, how accounts are reviewed, how taxes may apply, and how international transactions are monitored. Because once you enter the US financial system, you enter one of the most compliance-driven banking environments in the world. And international activity receives attention very quickly, especially when foreign companies, offshore structures, or cross-border transactions are involved. What US banks actually analyze. One of the biggest misconceptions international executives have is believing banks primarily evaluate wealth. In reality, banks primarily evaluate risk. They want consistency, documentation, transparency, and a clear understanding of how money moves. That means financial institutions increasingly analyze source of funds, source of wealth, corporate ownership structures, tax residency, and international business activity, and whether the movement of capital matches the client's profile. And this is important. Many banking problems are not caused by illegal conduct. They are caused by poor structure, weak documentation, or financial activity that lacks clarity from a compliance perspective, where executives become exposed. The exposure usually begins when successful professionals operate internationally without coordinating their immigration, banking, tax, and corporate structures. For example, using personal accounts for business activity, moving international funds without proper records, holding assets through poorly coordinated entities, or relocating to the US without understanding how reporting obligations change. And initially, none of this feels urgent until a transfer is delayed, until a bank requests explanations, until compliance departments start asking questions, or until unexpected tax exposures appear. That's when many executives realize immigration approval was only part of the transition, the compliance layer nobody talks about. One of the most misunderstood aspects of US banking is compliance review, especially for internationally active professionals, because financial institutions today operate under strict anti-money laundering, reporting, and beneficial ownership regulations. So when large transfers occur, when offshore entities are involved, or when multiple jurisdictions appear in financial activity, banks often conduct enhanced international review. And at that stage, documentation becomes extremely important. This is why sophisticated international clients prepare before moving funds, not after problems begin. Another major issue executives underestimate is how closely banking strategy and tax exposure become connected after relocation. especially if you maintain foreign companies, overseas accounts, international investments, trust structures, or cross-border income streams. This is where many professionals realize too late that immigration planning alone was not enough. Banking strategy, tax planning, asset protection, and corporate structuring all need to work together cohesively. What sophisticated clients do differently. The strongest international transitions are usually the most organized before relocation even happens. Sophisticated clients typically prepare documentation early, separate personal and business finances, structure international entities carefully, and evaluate banking, tax, and reporting considerations before major transfers occur. Because the goal is not simply entering the US financial system. The goal is operating inside it smoothly, transparently, and substantially. Relocating internationally is not only a change in geography. For many executives, it is also a restructuring of their financial life. And the people who navigate that transition successfully are usually the ones who prepare strategically from the beginning. If you are relocating to the United States as an executive, investor, or entrepreneur, our team can help evaluate the immigration, banking, corporate, and cross-border structuring issues involved before problems arise. And if this video was helpful, like, subscribe, and follow for more insights on US immigration, global mobility, and international business strategy. And remember, every US immigration story begins with one of three ingredients: love, talent, or money. I'm Tapias, and I'll see you in the next video.